ways to live and work efficiently for your whole life and in class. Invest in yourself and your financial security before investing in an employer. I will talk to you today about investing in stocks or Bitcoin and real estate. I'll also talk to you about career development and life planning, and then setting goals. This is what I want you to really focus on. Strategic planning and developing happiness and success. So it all hinges on what is your strategy. What do you do? Do you plan, or do you just go day to day and accept what life gives you? If you're just accepting what life gives, that's not planning, and life is going to hit you like a train. You must realize that life is like a game, and it's not a game that rewards just the hard worker or the smartest person. Sometimes it's not fair. You need to understand these rules and work with this game and understand what makes you happy. Who are you? And then how can you, or how should you live? Those are two completely different things. How should you live is very different than how can you live. Most people just live. Mom says, go to school, you go to school. All your friends going to school, you go to school. Everybody says, get a university degree. That will make you successful, but they forget to think about who's the most successful people in history. Bill Gates, Steve Jobs. Did they go and graduate university? No. So pay attention to these details. Can you be happy and work and earn income separately? Absolutely. So let's take a look at a couple of key words. What does wealthy mean? Wealthy is your invested assets generate income to fund your standard of living. Rich is different. Rich is your non-work passive income equals or exceeds living expenses. Happy, in my opinion, is you must know who you are, do work you love, and have passive income that passes active living. Some of you should not know what active living is or what passive income is. So we should talk about that. If you want more information, you can read this book, The Rich Dad, Poor Dad, or read the book, The Outliers, or 7 Habits, The 4-Hour Work Week. These are all very good books to help you strategize and develop yourself. I personally suggest the idea of getting a property. You can buy a property and then rent it out to other people. Those people that stay in the property are tenants. They pay that money to buy the property for you, and they can pay you a monthly cash profit also. So think about that. Some people say that, oh, I don't have enough money, or a house costs way too much, but they fail to research and learn the details. You can buy a house quite often for 20% of the price of the house. So you put down 20%, you borrow 80%. Also, in many places, especially in Canada and United States or Korea, you can put down only 10% and borrow the rest. There are places where you can put down only 5%. And if you research wisely, or if you ask me, I can teach you there are ways to put down zero money down payment and buy a property. There's also ways you could actually get paid to take ownership. Some of them might be complicated, but I'd be happy to teach you about this stuff. Let's talk about this overall. Overall happiness. Most people get a job and they work for some big company for most of their life, thinking that is their route to happiness. Research shows that a lot of people don't retire well. They usually have stress frequently, and they may have arguments with their bosses, and by the time they're 65 or ready to retire, they may not have enough money to actually retire. So this is a new concept. If I show you this, for example, this is a website that I'm showing you where it lists many properties. This property is, they're selling fast. But this idea of the properties, oops. Generally, it was showing this $900,000 house has an apartment where people can live upstairs with a 3-bedroom apartment, and there's 4 bedrooms downstairs, and you can rent that out to other people. So upstairs, again, 3 bedrooms, kitchen, and 2 bathrooms upstairs, and in the basement, you have 2 separate apartments. And in that area, apartments generally rent for more than $2,000 a month. It's the same price as if you borrow all of this money from the bank, you generally have to pay about $2,000 each month to the bank to own this. So one person renting will buy the house. That money goes to pay the mortgage. But there's 2 other apartments there that are luxury. You could live in one and rent out the other. Just that alone should start getting you thinking. Now, the next topic is you can buy for free. There are 0 down options in the United States. It's called the 203K program or the Oklahoma financing. There's also the home improvement loans and financing possible in Canada and other places. There's also ways that you can invest only 5% to buy a property. Whatever it is, that property starting at $900,000 that somebody else buys, regardless of the price, somebody else buys it for you and it goes up in value. If you check Canada, for example, Canada, the capital is Ottawa, and house prices there went up 19.8% on average last year. So 20% growth in the price of a house every year. And you just need a small down payment to start. And every year, somebody else is paying to slowly buy it, and it increases in value. Because it increases in value, the bank can give you money for that increase in value, and you can use that extra money to buy another house. And then that goes up in value next year, and you can buy more houses. So in your first year, your house goes up in value, and you can buy 2 more. And then that next year, you can buy 2 more from A and 2 more from B and 2 more from C, and it keeps replicating like that. Sounds strange. I encourage you guys to ask questions in class. Most people, however, they look at investing and they talk about stocks. They don't talk about real estate. Well, why? If you look at the big picture, you realize that a house doesn't usually change. And the idea of having a property that doesn't change isn't interesting. It's not news. So the news stories and journalists, they don't talk about it. And the idea of companies, they do change a lot. The CEO, like Elon Musk, can be spreading strange stories all the time, going to Mars, or Donald Trump creating stories that are crazy all the time. That is newsworthy. Stock is newsworthy. So you hear a lot of information about stocks, so people invest in them just because they talk about it a lot. However, the truth is stocks are usually not as good an investment as real estate and many other options. So check these details. I'm not advising you to invest. I'm advising you to think about details. I'd be happy to help. This cartoon is serious. Dear investors, please insert money here into the toilet. If you are renting a property, your rent every month is going into the toilet. If you're investing in stocks, there's a good chance your money is also going into the toilet. If you own a property, you, especially if somebody else is renting it and paying you for it, that is increasing in value. So you're getting wealthy from that. So check those details. This is an example. This handsome guy here, met him quite a while ago. He was a student studying business, and by the time we met, he was generally poor, but within a few short years, he took what we were talking about and he did it. You can do this very quickly. He did it quite quickly, and he actually retired or semi-retired in about 4 years. So by the time he was 20, he started learning about this. By the time he was 24, he no longer had to look for a job. He had money coming in from his rental properties, and his rental properties were increasing in value every year, allowing him to get more and more and build more and more. You should do the same. There are many types of individuals. This person thinks deeply, thinks wisely. You should do the same. Regular investors could be classified as a yuppie, young, urban professional, or a dink, which is a double income, no kids. Some of those double income couples, if they have no kids, they have extra money, so they use that money to invest. And then there's the young family that wants to invest, or midlife crisis, or the retiree. Then there's also the big institutions. So I'm not going to talk too much about the big institutions. I'm going to be talking about you as the individual when we're talking about strategic management. Later in the course, we will talk about managing companies. So make sure you understand there are different details and expertise, constituencies, liabilities. Learn as much as you can. Start with, since most people think money when they talk about success, understand that if you just put your money into a basic bank account, I call it put your money into a sock. I'm not saying stock account, I'm saying sock account. Then your money almost doesn't grow at all. It basically stays the same. However, if you do ask the bank to put it into an account that gives you compound interest, which you must understand, then your money grows exponentially. Start investing immediately. These sock accounts are bad. They waste your time, waste your money. Learn these details. Ask about and put your money into accounts that grow. How much does it grow? Compound interest magic. An 18-year-old invests $2,000 to $2,000 for just 6 years, and that would seem to be $12,000, and then they don't do anything else. If they walk away, they would retire with more than $750,000. However, if you wait and wait until you get a good job and get married and start getting serious and you start investing the same amount, by the time you're 30, you would invest $2,000 a year every year forever until you retire, and you still have less than that $12,000 the 18-year-old invested. You would only have $500,000 versus $768,000. Every year you wait costs you about 10%. Waiting 1 year costs an 18-year-old at least $75,000. So there's many types of investments. Government investment certificates or bonds or stocks, commodities, funds. Funds are usually better than these other details because funds are usually a little bit safer. Individual stock could go up or down, but nobody knows. And one thing I'll talk about later is that the stock, although you may think you invest in Tesla, because you like the Tesla car. Well, the reality is the Tesla car quality hasn't changed ever since it started. But the stock price goes up and down a lot. And so why? The reason is that the stock goes up and down, usually because of the news and what somebody is saying, unrelated to the company. If Elon Musk says something in an interview, the stock price could go up or down. The same for any types of stocks. Other than that, there's also the real estate, and there are dozens of different types of real estates. I am biased towards single-family residential real estate. It's different than commercial, different than apartments, different than industrial condos attached. Lots of details to learn about these things. So stocks, as I said earlier, they're open to outside influence. There's a few things you should be aware of. Stock manipulation and naked short selling is one of them. So those people with lots of capital can profit from pushing down stock price. Making the price of a company go down is a gamble. If you bet your friend, I bet this company price is going to go down, and he accepts, that is a bet. That is an investment. And if they're powerful with a lot of money, they can bet you and then turn around and tell the newspaper stories that that company is bad, or the CEO is doing drugs, or there's criminal activities, and the price will go down. That type of thing happens more than you can believe. So next, there's also the short selling or death spirals, convertibles, and stock manipulations. The idea that some people buy and sell stocks when almost nobody actually has the original paper ownership of the stock. You just have a coupon of the original, because the original is kept in national security vaults type of things. Then since the stock brokers and agents don't have those stocks, and they know that they're changing hands a lot, some people can trade them even though they don't have them. And so that's related to naked short selling. I think we're getting into some very complicated stuff. The overall idea that I want you to be aware of is that stock prices can go up or down, and it has sometimes nothing to do with the company, nothing to do with the product, and it's usually just related to outside chit-chat, gossip. This is another example. This is talking about fails to deliver. What I'm saying here, fails to deliver, means maybe you know of Netflix or Krispy Kreme donut shop. What this shows is on this date, there was almost 5 million stock transactions where the person investing didn't actually show ownership. So they failed to prove they had the stock, and yet they sold it. And so what this shows is Netflix, wow, I don't want to get in trouble, don't want to get sued by making anybody look bad, but the newspaper story talks about how 192% of all investment in this company on this day was done without that person having the ownership of the stock. So it's kind of fraudulent. Stocks overall underperform real estate. If we understand University of Michigan research, they studied things, the stock market from 1963 to 1993, and the same thing holds true from 1925 until 2015, 2021 now, it's the same. The average stock is getting about 11% profit. 11% growth every year. That is similar to the average real estate growth. However, if you didn't invest in Tesla, or you didn't invest in Microsoft or Google or McDonald's or Coca-Cola, if you missed those best investments, and more specifically, if you missed the 90 best days where stock went up like crazy fast, your stock would drop to 3% profit. And we see here from 1966, for 16 years, the average stock lost 22%. And popular investing now focuses on day trading 3 or more hours per week. The equivalent time, thought, and energy put into residential real estate investing can provide not only your superior profit, in my personal opinion, but happier communities and safer returns. And the risk with the stock price going up and down is more than 17% standard deviation versus 5% for the real estate. And that's what we're showing here. This is a different study, and this study is by researchers Hasanov and Dacey in 2009. They studied all homeowners and US investments in the United States from 1952 to 2005, and they showed that the investment annual profit and the standard deviation, or the risk, for real estate, it was again about 11% and only 5% risk, or 5% going up and down, versus the average S&P 500 stock. It's about the same, 12%, but 17% risk going up and down. Just that alone shows, no doubt, housing belongs in a portfolio as a major, if not dominating, asset. Provides a high average net return, low volatility, and a low correlation with financial assets, and provides a great hedge against inflation. Any non-economic reason for owning a house is just a bonus. We've gone through quite a bit, and you're probably already a little bit aware of bonds, stocks, government certificates, funds, indexes, maybe the general idea of real estate, entrepreneurship, investing in a company job. We're going to talk soon about investing in yourself. Although this is just a video, we will talk at any time. You can contact me. My contacts are always there. Sean.Watts.Teaching @gmail.com, and Sean Watts. You can easily find me on Facebook and LinkedIn. If you have questions, it's a good idea to bring those to class and talk about them anytime you can.